So with Tesla, I have to be careful because, man, if there was ever a bubble, this, in my opinion, this is definitely one.
Welcome to Critical Thinking Required, hosted by LBW. This podcast is intended for free thinkers, entrepreneurs, and knowledge seekers. Join us as we discuss relevant financial topics, explore with guests their financial journeys, and engage with experts in industries such as space, media and entertainment, real estate, and many more. Buckle up and enjoy the ride. Welcome to Critical Thinking Required. You're with your hosts, myself, Tim Bickmore, and my two colleagues, Nathaniel Leach and Dan Weiss. And today we don't have a guest. We're actually doing our quarterly update. And here we go again. So we're going to talk about a few topics today. It's going to be a little bit shorter than usual. We're going to hit IPOs and SPACs, Tesla, and Bitcoin. Everyone get excited. We're going to talk about cryptocurrency. I can see Nathaniel's excitement on his face right now. So Dan, I know you're going to lead the ship. So by all means, take it away and let's get this baby started.
Yes. So as you know, we like to pick out some of the hotter topics and just address them for our audience every quarter. That is this. So we say it's going to be short. We'll do our best. Let's start out talking a little bit about I'm going to call it a craze, the IPO craze. We have had recently in the last few weeks, Airbnb launched their IPO. We'll talk about what an IPO is. And they're not alone. We also have seen DoorDash do the same. In the last couple of years, we've seen this, and this happens. We tend to see kind of a wave of popular IPOs come out and then maybe not and so on. And with that, people get very excited. Should they get excited? We're gonna cover some of that. What does that actually mean? We have some thoughts in general about IPOs. Maybe we'll even talk about a little bit of that too. So let's see. Who wants to start this sucker out? Oh, we have a volunteer. Nathaniel, why don't we start talking about what an IPO is?
So an IPO stands for an initial public offering. There are many ways of coming for a private company to go public. One of them is an IPO. So what an IPO essentially means is for a private company to essentially allow their private owners to price out their ownership and actually see what the market values their ownership at. And the IPO does this by the company saying, okay, we're going to go public by issuing out essentially 10% of our share count to be bought by public shareholders, you and me. This allows for those private business owners, those investors in that business, to essentially liquidate some of their holdings so that they can realize their investment. That's all it is, folks. It's an opportunity for those investors to get a return on their investment. And how do they do that? By having other people buy their shares. That's it.
Sounds a little bit, not saying that it is this case, and it's not, but it has some remnants of some Ponzi stuff there, right? You basically are passing
the greater fool theory. Yes.
Yeah.
You find the sucker to buy your shares. Basically what happened.
And then, of course, an issue we've always had with IPOs is not specific to many of the companies necessarily. It's the lack of information that can be attained. The issue is when we're talking about private entities, although there are filings and that does provide information, there's still not a public track record for us to bring into the picture. You want to maybe talk a little bit about that, Nathaniel?
Well, about the public track record piece, I mean, I don't know if I quite agree with that sentiment in that the filings that are called S1 filings, when a private company states they're going to go public, where it's all of this information, and these things usually run like 400 to 700 pages long. So there's quite a bit of information in them. I would actually argue that in some cases there's too much information because it's been run over by lawyers, and there's so much legal speak in there that they can sometimes bury bad things in it. And if you're not an eagle eye reader with lots of experience reading these things, you might miss it. But there is, like, in those S1 filings, they're only obligated to go back a certain number of years. I think it's 3 years at most. They can choose to go beyond that. But the last 3 years may look super rosy, and all of the years preceding that, they might look like, well, they might look like something nasty. Let's just put it that way.
Maybe we can talk as an example about Airbnb that recently IPO'd, and what occurred there, what was maybe expected and anticipated, I suppose, and what really happened, and why that happened to be the case.
So I think that you're alluding to that there was a lot of talk after Airbnb's IPO that it had been mispriced. So IPOs are notorious. It really is a backroom boys club, so to speak, in how these IPOs operate, because it's literally the company going to these bankers, these underwriters, these investment bankers, is what they're called, and asking them, hey, if we're going to sell this many shares, how much do you think we should price this at? That's legitimately how it goes. That in no way is the way it should go. You as a business owner should have an idea of what your company is worth based upon the scale of your business, and because maybe you're not at free cash flow positive yet because you're building for scale. You have an idea of what your company is worth. For you to go to an investment banker and ask them, what do you think we should price this at? Come on. So the other aspect, though, is you want to look at the price that they set. The way that they set that price is, of course, highly subjective in terms of, like, what do you think this is worth? But it's also subjective in the sense that the investment bankers are going out to their institutional clients, these big pensions, these huge hedge funds, and saying, how much would you be willing to pay for it? Put your order in. And then they do like a consensus of the prices that they're receiving and saying, oh, it should be between this range. So in part, they're determining what the market is willing to pay for it. The market consisting of these institutional clients, and there is some legitimacy to that, in my opinion. But on the other hand, I feel like there's an illegitimacy in the sense that it's that highly subjective part. Like, what are they basing that on? They're basing it upon their estimate of value, and the thought is that by taking a consensus of those values, that you get an appropriate range. Well, apparently that's not what happened with Airbnb, because Airbnb was priced at, I forget, it was like 48. They initially started at, it's going to be 30 billion. And that was in the $40 range per share or something like that. Well, what did they end up? They ended up over $100 a share on day one. So why is that a bad thing? It's a bad thing because they were selling, as we discussed earlier, an IPO is Airbnb issuing out stock to public shareholders, to public people who want to buy into their company. And then they receive, Airbnb in that initial offering receives those funds for the shares that they are selling. They sold at that dollar amount and they received that much for the number of shares that they sold. But with the share price closing at over $100 a share, I think it was, they lost out on that spread for their IPO. So it was over double what they could have received. So the investment bankers did not price them appropriately based on what they had thought the market thought Airbnb was worth. So Airbnb, based on the amount of shares that they issued, I think they left on the table like $4 to $5 billion of extra cash that they could have then taken back into their business and reinvested into the business. Simultaneously, the amount of shares that were issued were also investors who were saying, "Hey, I want to sell my shares. Hello, I want to sell my shares. Hello." Those guys, if they actually held on past that first day surge, and then I'm not even sure if they were subject to lockup periods. Like most IPOs, investors are held to the private investors, the initial investors in Airbnb are held to a 6-month lockup period. I don't know if that was the case for Airbnb, but if there was, they were able to partake in this huge upswing in their valuation. So then they're going to make out like bandits, provided that Airbnb 6 months from their IPO are at that high price range, of which who knows what's going to happen.
Any other aspects that maybe we should focus a bit more on lockup period a bit and explain exactly what can happen and why it happens with lockout periods expiring, or any other aspects you want to handle there before we start talking about a subject that you love, SPACs, coming up next?
Just real briefly, most IPOs are subject to what are called IPO periods, where the investors, the private investors, cannot sell their shares on the open markets until 6 months, 9 months, a year after the IPO. It all depends on the company. And that is to ensure that on day one, they're not selling all of their shares and trying to get out, because what's going to happen? The price is going to crater. So it helps to ensure lesser volatility going forward on the downswing. So when those lockup periods end, be careful.
And to chime in on that one too, what's interesting, and we have a few clients and different people that we obviously have talked to that are part of companies that have IPO'd, right? And what happens is that the lockup periods Nathaniel is talking about may be specific to a certain document or whatever he's talking about, but then you also have insider trading rules. So for executives in certain areas that you're in the company, then you have to be very careful about those rules. And there's plans called 10B5-1 plans that essentially state that you can only sell your shares at certain times, and you have to actually decide what kind of shares you want to sell, typically I think over an annual period. And that also then is dictated on kind of blackout windows. So it's like, hey, once quarterly reports come out, you can't sell your shares. So what's interesting, and I've just tracked it through one company, is that you'll see the price dip on when those windows open up, because it's just the employees trying to liquidate their shares because they're holding it at a lot cheaper price than anybody else, because they've had it from ISOs, NQSOs, right, RSUs that are becoming due, and they're just trying to liquidate their investment. So, you know, in the early years, it's just very interesting to see some of those liquidation periods come through. So, and it really is bucketed into certain timeframes. Now, I'm not saying go do the research, figure it out so you can try to play the price, but it's just another interesting aspect to IPOs, because at the end of the day, you know, it's Nathaniel's right. Airbnb might have given up $5 billion, but the owners of Airbnb, they didn't, right? Like they made it in their own pockets. They took that money. They were excited to probably hit $100 a share if they had the ability to sell. And I think a lot of employees, it gives them the way to liquidate and have that liquidity and not be so illiquid. And so but it's a different ball game than the next investors getting into the IPO tranche. It's interesting to think about it from that standpoint.
I know you're excited for that. Why don't we do that, Nathaniel?
Okay.
What is a SPAC? Why is this important?
So a SPAC stands for Special Purpose Acquisition Company. So a SPAC is what is also known as a blank check company. And they have in the US lifespans of 18 months. And what they do is they go to investors and they say, give me a bunch of cash, and over this 18-month period, our intent is to find a company, private company, most likely, to merge with and essentially go public. It's just another method of a private company going public. And in 2020, there was a huge rash of these SPACs coming to market. There's a craze going on. Who knows if it's going to be a bubble or not? Because if after 18 months they can't find something to buy, then they have to dissolve and liquidate. What's going to be interesting is that because there was just this huge wave of them in 2020, and with the 18-month time frame, what's most likely going to happen, and what has already happened to an extent, is the SPACs that got out early out of the gate were the ones most likely to find good priced deals. The SPACs that came out later in the year, they're going to be pressured to find good price deals because all of these private companies are being bid up by all these SPACs to go public. That the SPACs that came out later are going to be hard pressed to find a good deal. And if they can't find a good deal, then they might actually go one step further, maybe not do as much due diligence just to get their foot in that 18-month time window, and then close these deals that might actually not be of good value to the investors. And then you might have a bubble pop. Maybe. We'll see. It's going to be an interesting intellectual exercise. I'm excited. It's not to say that SPACs are bad. I'm not saying that. I don't think IPOs are inherently bad. It always has to do with just how they're executed. So that just remains to be seen.
Or what you're referencing to is the incentives behind the vehicles, such as the 18-month time frame, can force you to do things you may not want to.
Yeah, and that's not just one incentive. The biggest incentive that most people harp on with SPACs is that the company or individual who is backing these SPACs, they get what are called founder shares, 20% of the new company. And in most cases, they're not putting up a lot of capital that is equivalent to 20% of the resulting company. They're just essentially walking away with, I started this SPAC, so I'm going to walk away with 20% of the new company. They normally make out like bandits. So if you ever do a SPAC, you want to find a SPAC that is being set up and run by a company or individual or group, a team of people that has a good reputation, not with SPACs particularly, but just a good reputation. I think that's really quite critical.
Yeah, the scary part is just that people enter into these kind of concepts and the ones we're about to talk about next with not enough knowledge really of what they're getting themselves into. And that can be a very dangerous element. And so with that being said, let's talk about something that for the last number of weeks, somebody brings up at least daily and usually multiple times throughout the course of the day. And that is Tesla. We touched on Tesla a little bit as they were entering into the S&P 500 a few weeks back, and some of the elements that go along with that. We're going to highlight it more because since then we've only heard more conversation about it, and probably again a lack of understanding. So, Nathaniel, you want to drive the conversation on Tesla? You like what I did there? Huh?
Yes. That was really bad, but okay. So with Tesla, I have to be careful because, man, if there was ever a bubble, this, in my opinion, this is definitely one. But a lot of people are, I feel, emotionally charged about Tesla because of how well it has done in the past year or so.
740% last year.
Yep, it has definitely risen. What I hope people understand about Tesla is that it is the majority of its cash flow, its free cash flow. This is the metric that we live and breathe by. The majority of Tesla's free cash flow today comes from its tax credits that it receives. So I think I mentioned this the last time we talked about Tesla on the podcast. Tesla is paid by other car companies for the tax credits that it gets because it's an electric vehicle company. Those credits that Tesla sells comprise the majority of their profit today. Their free cash flow in the last 12 months is a little over 1.8 billion. So on a trailing 12-month basis, they're selling at, as of close today, at about 768 billion. So I'm just going to bring out my calculator here and I'm going to do the math on that.
I love when Nathaniel brings his calculator out.
Well, thanks, Tim. So they're selling at a multiple. Oh, my dear sweet Lord. They're selling at a multiple of 420 times earnings. That would mean that's the equivalent of saying that they would have to grow for the next 40 years at about 16% for today's valuation to make any sense. So if you then take that 1.827 billion and you grow that at 16% for the next 40 years, you would have to, their free cash flow would equal almost $700 billion in today's dollars for that to make any sense, for that valuation to make any sense. Hands up if anybody thinks that that's going to happen.
And Nathaniel, for our listeners, like give a company who has a really, really high free cash flow number today. If you know off the top of your head, it'd be like, oh yeah, this company's making 20 billion.
Sure. Berkshire Hathaway, they're making over 20 easily. They're anywhere from 25 to 30 billion on a normalized free cash flow basis per year.
Is there any other, and again, I guess this is kind of a talking point, is how a person views Tesla. Is there any automobile entity doing that?
No. No, not at all.
And honestly, and I don't know, Nathaniel, if you've read this book or not, but a lot of, I think what we're going to talk about in the next subject too, is really related to narrative economics. And now Robert Schiller wrote that book, and it's not that that's the full focus or the sole focus of Tesla's price, but I definitely think it's a big driver that everyone's just assuming that we're going green. You know, even if you looked at today specifically, knowing that the Democrats are going to own the presidency, own the House, own the Senate. So everyone's like, oh, green, you know, the new Green Deal, it's all going to get pushed. Tesla's going to be the one. So it's this focus. It's almost like comparing to people now saying the pandemic, Peloton is going to be the new thing, right? Like, and people are just driving behind that narrative of pushing things forward. And that's what it really reminds me of Tesla, is like electric cars, but it's becoming so out of whack that the narrative is really overblown in a sense, like, and specifically
Absolutely.
with Tesla.
Yes, it has a first mover advantage. Honestly, I think in the U.S. especially, I think that green energy, the concept of going green, I think that is something that we should do as a species in order to survive here on Earth. I think that's essential. How we're going to get there, I have no earthly idea. And I think that companies like Tesla will help us achieve that. But does it make sense to invest in a company that's selling at 420 times earnings, where they have to compound at 16% for the next 40 years? Is that possible to achieve? I think it's possible, but But is it possible for a company that's already at such a high market cap to continue to grow at that rate? No, I don't think it's possible in today's numbers.
Nathaniel, I don't know if you've done this or not, but I'm just curious. If you were to take and say that Tesla made all the cars in the entire world, do you think they could hit the free cash flow number that you just quoted of 700 billion?
I don't think so. Off the top of my head, no, I don't think so. Free cash flow, no.
And that's selling literally all the cars.
Yeah. I read somewhere that in order for Tesla to make the goal amount of cars that they wish to achieve over time or in a specific year, all of the rare earths that are needed within today's batteries that they use, there aren't enough resources in the world to do that. It's not feasible.
Nor emission friendly.
My wife, Ying, is from China, and she has told me horror stories of these cities or regions where these kinds of electric batteries are produced, and the amount of pollution that is released in the production of these batteries is horrendous and extremely detrimental to the people who live within that region. Like,
Nathaniel, I have one other question related to Tesla, and I've thought about this one. Now, I feel as if there's a lot of FOMO when it comes to Jeff Bezos and what he's done with Amazon. He's created a very powerful machine in a lot of different ways. Now, you could question the price it's currently trading at versus its value. But what people really would have bet on Jeff Bezos isn't necessarily Amazon, but kind of betting on Jeff Bezos to come up with companies and continue to innovate and push the products and push different things. I think if you look at Elon Musk, are people buying Tesla because they're looking at SpaceX being successful, that he was in PayPal and it was successful? You're looking at other things that he was involved with, and he keeps pushing the limits, reinventing, and they're just trying to ride that potential train. And that isn't necessarily tied to Tesla, but tied to Elon Musk.
I honestly don't know. I think that there is some aspect to that. Like, there's rumors that Elon might use Tesla to take SpaceX public. Maybe there might be a merger of the two, and he could then realize that value in that fashion. I could allude to our podcast with Rick Tumlinson the other day, where he pointed out that he believes that if you look at all the companies that Elon is involved in, all of them have applications in space and or on other planets. One could make that determination. So I think that there might be some aspect to that as well.
And then there are also, of course, the more qualitative elements of the entity, if we're not looking at it as a space propeller and more so a car entity. Experts that we've spoken to that are concerning because they're not going to make every car in the world. They are the first, but won't be the last. They're competing with other automobile giants that can make cars with that basically cost less and do the same functionality, or perhaps even better. There's a lot of issues with Tesla's design. It's very pretty, but there's a lot of issues from a functionality standpoint with the car itself. And so competition will be there. They won't be the only place making it. And speaking this morning with our team member, Darren, and hearing his perspective, he's a major car enthusiast, about what European car companies are doing to improve the engine components in cars that are not going to be powered by electricity. And are there bio-friendly ways to do that? It's not the only show in town. All right, and one more topic for tonight, and Tim, we'll throw it to you. And we've heard this by now. I'm sure that everybody has kind of grabbed the theme for our quarterly update in this, which is, as Tim mentioned, well, here we go again, because every one of these topics we have heard again. And there's a few that we're missing, like cannabis, which might get highlighted in some of this, but this happens. We've seen a couple bubbles with Bitcoin so far, and we've seen a significant rise in this particular concept. So we'll spend a little time talking about it, and what we have seen is people get hyped up, and then something else comes in place, and then that goes away, and they get hyped up, and it's just a reoccurring event, often driven by what Tim said, fear of missing out. So, Tim, Bitcoin.
Yeah. I will say I'm not an expert, but I've definitely looked into Bitcoin. I've looked into cryptocurrency. It's interesting. It interests me in a lot of different ways. But it's really a lot of clients ask about it. They asked a lot about it. I believe it was in 2018 when I had a big run up, and then Bitcoin dropped, and now it's come back. I think that the recent events such as the pandemic, COVID-19, I think the stimulus packages that have been put together to support COVID-19 across the globe, not just in the United States. And then I think also part of the drive recently has been the idea of what's happened at the Capitol. Now, I'm not trying to get into the politics, but the reason why that was important was because it's really the thought of true decentralization, meaning no one can control it. The government can't control it. There's nothing there. I think the thing, though, is when clients really want to start looking at the crypto world, they really need to understand what they're trying to get into. I would agree with a lot of experts who've done a lot of research that Bitcoin is not necessarily a payment system. Bitcoin is really a store of value, very similar to gold. There's been a lot of saying out there that Bitcoin is the new gold. Now, you can make that argument one way or another. Is it or is it not? But the reason why it's analogous to gold is because there's a finite amount of it. There will only be so much to be produced. Now, there may be a way to go and hack it and add more Bitcoin. I don't know. I've never looked at the code. I didn't read the research paper. But overall, they're saying there's only a finite amount, just like there is gold. Similar to gold, it's just whatever people feel the value of gold is. It's a simple supply and demand economics. If there's a finite supply and enough demand, it's going to drive the price up. That will happen. Now, where people will start making the argument is that institutions have started to get into the play, that people are really looking at it as a hedge against inflation, as a hedge against currencies, because there is this decentralization of it. And that's what's kind of been bringing more of the crowd to the game. They're also making the argument that if you compare it to gold, gold's very hard to store. What are you going to do with a kilo of gold, where you can just put Bitcoin on a USB drive theoretically and put it into a lockbox? Like, it's just easier to store. It's easier to handle. It's easier to track. And you know exactly how much Bitcoin is out there. But if we're talking about Bitcoin, that's Bitcoin specifically. I'm not talking about Bitcoin Cash. I'm not talking about Ethereum. I'm not talking about Litecoin. That's a whole nother side of the cryptocurrency world. Based off my understanding, a lot of those other cryptos are really more trying to be on a play of blockchain and taking advantage of that technology and going more after payment systems. So if you're going to go ahead and invest in companies, you really have to start deciding what you're investing in. Now, I do not think that there's going to be a currency that will replace the dollar, that will replace the yuan. I doubt that there will be a world currency that's a cryptocurrency. And the reason why is because I don't think the US wants to give up their monopoly on the dollar. And I don't think China wants to give up their monopoly on the yuan. And I don't think that China and the United States and Russia and Europe are going to get along enough to be like, hey, we'll decentralize this and no one has control and it's all free game. I personally just don't feel that way. But that's when it comes down to specifically looking at it as a currency. That's where it's really starting to separate the ideas of currency versus what is called store of value. Now, with Bitcoin specifically, can I get behind the idea of that? yeah, it's really, really interesting. It's an interesting thought process. It's interesting to see what that's really going to happen. A lot of people seem to be putting their trust behind it. You have the bears of the talk saying there's no utilization of this asset. Gold is still has the ability to be used in some form or fashion. You can use it for rings, jewelry, different things. Where Bitcoin or any other crypto asset literally has no function other than being stored on a computer. But that could be enough to have it be a legitimate, new asset class. I'm not trying to be against that or for it, but that is the con against it. I think Dan's had conversations with a few different people when it comes to cryptocurrency in the sense of the legality of it. There is a way that the government wants to track payments because that's how they prosecute crime. Is the US government going to give up that freedom? Now, I think depending on who you talk to, maybe people want that. Maybe they say it's the new way of the world. But at the end of the day, if you really truly had that, there could be some really bad utilization of that type of a system and a lot of negative facts that come with it. So it's really a convoluted industry. I think that, to kind of go based off of The Third Wave by, I think it's Daniel Case. I always talk about that book. I think he makes an excellent point that cryptocurrency is getting into disrupting markets that aren't. Someone actually said this, so I'm going to take it from him. It's you can't put people behind a keyboard and solve the problem, right? Cryptocurrency starts getting into very real hard problems because you're talking about trust, you're talking about control, you're talking about things that can't just be solved by a computer. And so it's not saying that that cryptocurrency isn't going to be a thing, not saying that Bitcoin isn't real or not real. It's just more that this is a very evolving industry. It's very, very new, and it's very hard to pinpoint where it actually will be. So I think that's where we just get a little uncomfortable with it, that there's a lot of other ways to make money. Maybe people make a ton of money in their cryptocurrency. Good for them. But, the last time that I really looked at people who've made a large sums of money weren't gold owners. They were business owners. Jeff Bezos doesn't own a bunch of gold. He owns Amazon. Elon Musk doesn't own a bunch of gold. He owns Tesla and SpaceX, right? So it's really kind of looking at, not saying that it can't be a hedge or there's not a play within the portfolio, but it's a very evolving industry. It's very new, and there might be something that comes out of it, but it's just really too early to tell for my taste personally.
And the legality element to it is not just a liability issue, but of course a morality issue that businesses, people, and governments would indeed have to face. Nathaniel, you had your hand up. Did you have something you wanted to add to that?
Just a few interesting points, I think, on Bitcoin in particular. So from a Bloomberg article on November 18th of 2020, there's a statistic in here that really just blew my mind. Quote, about 20% of the anonymous ownership accounts that can be tracked on the cryptocurrencies, that is Bitcoin, blockchain, control 95% of the digital asset. So I bring this up because that means that the vast majority of Bitcoin is concentrated in 2% of the anonymous owners. So what that means is that it's a supply and demand. It's liquidity, essentially. So when you see these big price moves up as well as down, that's those big whales, is what they're called, that are liquidating their Bitcoin, or vice versa, buying. And I think that people should be aware of what's driving those prices. It's literally the supply and demand of the market and the liquidity of who owns how much. It's just something that buyers of Bitcoin should be aware of.
I think that from the standpoint that a lot of people, or people we've read, talk about it as an asymmetric return opportunity. And to kind of boil that down very simply for listeners, that means you're risking a very small percentage of your portfolio, say 1%, and hoping that it does go gangbusters and you make a lot of money. But if it goes to zero, you lose 1%. Can I get behind that kind of thought process? Yeah, I think you can. It's a nice way to play. I mean, Nathaniel talks a lot about it for, entering in certain positions, just a small amount to get a feel for it. It's a good way to get a feel, understand it, to actually be in it. But to risk a lot of your worth into cryptocurrencies, I think Nathaniel's right. That can be extremely risky if you really truly don't understand it and really know what you're getting yourself into and what you're actually investing in. And just like Bitcoin can go up, if people were to exit Bitcoin, right, and trade in back into the dollar really quickly, the best way I can think about it is if going to a concert and trying to, all these people getting shoved out one door, that makes me claustrophobic. Very, very claustrophobic, because it creates a big, big traffic jam, which means I can't get out.
I think that's probably a great place to end the conversation. I'm really not interested in what is hot, because what is hot always tends to become cold. I'm interested in just quality, logical things that make sense. You got to be careful what you ask for. It just perhaps might be something you don't actually want to get in the long run. It makes me thinking of Tesla and just people's comments over the last couple of weeks. I don't know how many times that the day that Elon Musk took over Jeff Bezos on being the richest man in the world, how many times I heard it that day. I'll tell you right now, I don't know why people have interest. Usually when someone has interest in that, they're not admiring necessarily that person. They're thinking about what that might feel like on them. So, whenever someone says, I really want to be a millionaire, what they really are saying is they want to spend $1 million. That is the opposite of being a millionaire.
Oh, Dan, always making me follow you up.
I took that from a book, but it's cemented here because...
Hey, I can understand why it's cemented. I can understand why it's cemented. My final thoughts, I'm just going to, kind of, since I talked up Bitcoin the most and cryptocurrency, is I don't know if I'm right or wrong. I don't know if, Bitcoin takes over all store value assets, silver, gold, platinum, you name it. I have no idea. And I don't know necessarily what Tesla's going to do. But the more and more I do this job, the more and more I start thinking, there's a lot of ways to make money in the market. There's real estate. There's the stock market. There's business. There's a lot of different ways to make money. And I'm just okay making the money the way I know how to make money. And I'm not as worried about how others are doing it. And I'm not worried about missing out, because as Dan mentioned, it's just not my game that I want to play. And if you really start looking and listening and reading to people who have been what you would define as successful because of their wealth, they also were very good at what they did, and they focused on what they did. So Nathaniel would talk about that as a circle of competence. And I will say it's taken me a few years to really come to that idea and really understand what that truly means, but it's slowly getting there. Now, I will admit, I'm a fox. I like shiny things. I like to go learn. That's just who I am. I'm curiosity at the heart. So I will, but that doesn't mean I'm going to deploy a large amount of assets into stuff that I don't know. I'll be strategic. I'll make sure I'm slow to the play, and I'm okay with that. Boring is becoming the new sexy for me, and I wouldn't have said that 5 years ago.
You bet.
That's a great line, Tim. That's awesome.
Well said.
I'm proud of you, bud. Takes a somebody who's very strong in their understanding of who they are, their self-awareness, to say that. Good for you.
I credit a lot to you, Nathaniel. So,
well, thank you. I appreciate that. For me, it's pretty simple. Be rational in what you're investing your hard-earned money in. I mean, if you put too much of one thing in something that you don't truly understand, if you didn't know about those tax credits for Tesla and you're invested in Tesla, maybe you should go back and take a look at that. What do you truly know and understand about that company? If you didn't know that 95% of Bitcoin is owned by 2% of the anonymous ownership accounts, and you're invested in Bitcoin, you might want to go back and take a look at that. If you didn't know what an IPO stood for, if you didn't know what was entailed in that process, what you were buying, if you didn't understand the company that you were investing in, you should probably go back and look at that. Because if you have a high concentration in that, you could get hurt financially. So as always, just understand what you're invested in. If you know that you don't understand it, don't be afraid to pull the trigger and get out. Because if you let that mistake ride, you might be left with nothing.
And on that note, thank you very much for joining us for this quarterly update. We hope the information was helpful. Have a great night, and thank you to listening to the three of us think critically. Take care.
Thank you for taking the time to start your journey of thinking differently and listening to LBW talk about stuff they love. Until next time.